My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You can't make up these moves. I'm talking about the big runs in all sorts of stocks going into earnings, runs that raise the stakes to dangerous levels for those who want to buy stocks before the company's report. And you can't see it in the averages where the Dow gained 273 points today. Dow is up 0.27%, NASDAQ advanced 0.26%. But it's pulsing underneath virtually every major company I talked about in my game plan on Friday traded erratically high today. Let me explain. First, you need to understand that no one knows these earnings numbers ahead of time, except the CEO, the CFO, and a very small group of very important people in each company, and they are tight-lipped. The analysts often try to sound like they know, but we've seen how wrong they can be over and over and over again. So when a stock roars into earnings, it's not like it reflects inside information. It simply reflects excessive enthusiasm.
House of pleasure.
In other words, these stocks are going up on nothing. And that, I think, makes them very dangerous. That's what we got to talk about. Let me give you some salient examples. Tomorrow night, we hear from Alphabet, which is up nearly $20 from its September lows, including a buck and change again today. Alphabet's notorious for not delivering its most desirable set of numbers. There's always a revenue number that's a little off, or an outsized loss in the other bets catch-all division, or some figure that shows that they paid too much for too little traffic. This time the issue might be management is defensive about Gemini or their AI platform. Even when the quarter's genuinely good, Alphabet can make it sound bad. Oh, and maybe they reveal that Waymo's losing money hand over fist. We got a brand new CFO here. Maybe they want to tell things differently. Very hard for the stock to go up on earnings unless nearly everything goes right, and for this company, it rarely does. Then there's AMD. Now, I think this stock is dirt cheap. We buy it for the trust, but the company just bought ZT Systems for $4.9 billion in cash and stock in order to compete more aggressively with NVIDIA. AMD said it intends to break off ZT's data center infrastructure manufacturing business, the hardware component, and sell it. What happens if they don't sell it? What happens if they can't sell it? Will the stock get dinged? Clobbered. How about these new AI-fueled personal computers? Are they selling well? We hear no. Like all these stocks, there are a ton of variables, and no one knows the answers except CEO Lisa Su and a couple other people at AMD. But I do know that AMD's run up nearly $30 from September lows, advancing another $369 today, and that makes it more precarious. All right, how about McDonald's? When this stock fell from 316 to 292 last week on the E. coli outbreak, I thought it would be immunized from anything negative. But now it's creeping right back up, rallying $4 today on what? On what? That it's reintroducing the quarter pounder sans onions in some states? We don't want that pre-earnings rally. We want the stock to have no fluff so it can go up 5 on a good quarter. Now it's borrowed that upside gain. It'll go up, but I don't know how much anymore. Wednesday morning, classic. It starts with Caterpillar, which rather notoriously reports a headline number that's immediately traded upon before we get any of the small print from the company. You get the headline earnings and sales numbers, but they don't tell you everything you need to know. In fact, they're not even, in many cases, the most important thing to know. People will want to know about inventories. And if Cat's up big on sales and earnings, it can go down big on inventories, or in other words, where the big trucks are. So, sure, you're going to get some terrific verbiage about the data center. You need Cats to build that stuff, including their backup engine. Remember, by the way, I saw the Cat solar engine on the rig last week. I'm sorry, the platform last week. Now, I think Cat's doing amazingly well. They've been able to stop the chatter about lower sales in China. It means nothing now. But, man, this thing is already up more than $60, 6-0 from September lows, and attacked on nearly 5 points today. On what? I say it's run too much. And I like the company very much. Wednesday afternoon, It's Meta and Microsoft. Now, I think Meta is the cleanest one of all the stocks, okay, that's going to report this week that I've been talking about. Last quarter, Mark Zuckerberg laid out a strategy where his company becomes the most important place for a company to advertise, like these big consumer products, like the Colgates. In the future, you just wire money to Meta, and they design your campaign and place the ads where they should be and have to go with people who want them. Everything's targeted. Customers will save billions of dollars. But, geez, Meta jumped nearly $5 today on nothing. Fortunately, at 578, it's still well below its all-time high of 602. I think it's the least problematic of the big names we're hearing about this week. As for Microsoft, well, maybe you caught a break in this one with the stock down $1.50 today after being up 4 at one point. Now, you need to discount. You need that discount. Why? Because we keep hearing that Microsoft's Copilot, much vaunted Copilot, I should say, has stalled. It's gotten some mixed reviews, including from Gartner, very important source of information. It's being knocked on Twitter by Mark Benioff, CEO of Salesforce. The long knives may be out for Microsoft. So if there's a dent in the sales, look out. We also have to worry about Azure, the web services division, which can upset people, even if it only misses by an infinitesimal amount that you and I can't see without a microscope. Microsoft is no longer the lock it used to be. Thursday could be dreadful, people. You know I say own Apple, don't trade it, right? But having the stock up $2 today, setting it within $4, spitting distance of its all-time high, that's a prelude to a nightmare. We've heard so many firms ahead of this quarter, and almost every single one is negative. They're going to miss, they're going to miss, they're going to miss, they're going to miss. Oh, and did I mention that they're going to miss? There aren't enough iPhone orders. China's terrible. Who cares about AI when you can't see it? Neither AT&T nor Verizon called it as doing well. They didn't say that. And T-Mobile said it was good. And the stock's so high. For some reason, the drumbeat of negative news about weak orders and lousy lead times hasn't impacted the share price this time. I say strap yourself to the Apple mast because it could get real choppy/ugly. Now this stock's got to be a perfect report, okay, to go up from these levels. And I think the word perfect does not come to mind when we're talking about Apple's quarter. All right, how about Amazon? Now, there's so much that could go wrong here. The last time Amazon reported, it missed its retail sales number, causing people to head to the exits all at once. The stock got plummeted all the way down to 161. Didn't help. Forecast was bad. Forecast is the forecast. It's now back to 188, yet there's no sign that retail's improving. And if you think back, they gave you a downbeat forecast because of the attempted assassination of Trump, as well as the Olympics. Now, you can never count Amazon out, but I do not love the risk-reward here, even as we own the stock from a Chapel Trust. Then there's the problem of Project Kuiper. Kuiper, it's like Mel Kuiper, or it's like that really weird green liquor. Amazon's money-losing satellite internet system, his service is Kuiper. Elon Musk's allowed to lose whatever the hell he wants, right? I mean, he can do whatever he wants because SpaceX is private. But the same $2 trillion, he could lose $2 trillion. You know, they make it up with a deficit. But the same rules do not apply with Amazon. I think Kuiper comes in a negative, not a positive way, and people are going to say, I didn't know. You read this piece on CNBC.com today, you'll know exactly what I'm talking about. Go there. But wait for the show then. Every one of these tech titans will be held up to scrutiny about their data center spending, and they'll be asked about the monetization of what they spend. Each one better have a good answer, certainly better than what Alphabet did say last time, saying it's necessary because the other guys are spending and you have to keep up with them, then their stock will be sunk. Even if it's a legitimate explanation, don't do that one. Every one of the tech titans will also be accused of writing too big a check to Jensen Huang at NVIDIA. They'll try to say that they're developing their own chips and they don't need Jensen Huang, but it won't be. Let's say it could be disingenuous. How about that? Look, I am indeed trying to discourage you from trading these stocks ahead of the quarters. It's just a roulette game based on nothing. Often the game feels rigged. You just don't know which way it's rigged. Because companies really and truly do not let this stuff drip out because it's like really bad to go to jail. Jail, bad. The spigot is closed. Bottom line, no one on Wall Street knows what any of the quarters will look like except for the principals. So don't bother to follow the money that you see trading right now in anticipation. You know why? It's a fool's errand. Chase in South Carolina. Chase.
Booyah, Jim. How you doing today?
I'm good, Chase. How about you?
It's a great day in the state of South Carolina. I have a quick question about Honeywell, and been a long-time player in it and a holder in it. It's done very well, and would like to get your thoughts on its recent activity in the marketplace.
Well, the quarter was very poorly received, and you know why? Because it was a very poor quarter. I was not happy. I had this great-grandmother, Nana Mary, and she always said to me, if you have nothing good to say, then don't say it. Nana Mary was always right, even about Honeywell. I'm trying to discourage you from trading this week's big cap stocks ahead of their quarters. It's a guessing game, and I don't recommend it. By the way, people did it on Honeywell. How you doing, partner? On Mad Money tonight, I'm checking up on HCA Healthcare to see if a pullback could be a sign to buy. Plus, you called in, you stumped me with the Sport Radar Group, so I did a little research, give you a rundown. And later, where does HPE, Hewlett Packard Enterprise, stand in the AI race? I'm getting the latest from its CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.